Environmental Trading Edge LLC and its members are not broker-dealers or financial advisors. All these webinars are for educational purposes only. All of our indicators and such are for personal use, non-commercial use, and are not to be construed as a solicitation of any products to buy or sell. They are not recommendations, and always talk to a financial advisor for any kind of financial advice. Past performance is not indicative of future results. You can always pause the video if you're looking at the recording right here, or review it on your own time.
Well, I'm really excited because I want to learn more about this too. We got a question about, they say that they understand the mechanics of moving the upper and lower butterfly leg in and out.
Okay.
Like how to put the trade on, how to adjust it, right? But they struggle with how it's going to affect the trade overall in terms of change to delta, etc.
Okay, so let me kind of get this, make sure I'm ironed out before I kind of dive into, like, you know, something deep as far as answering it goes. There is this concept of say moving a leg of a butterfly, or moving an existing structure, and what that does to the risk graph or the risk of like ranges. Is that correct?
Yes, and I think I would like to add to that. I know there's a lot of, if you need to adjust your delta, and I know you're not big on delta, so if you need to adjust your range, wake up, things have not gone perfectly to plan, so you now need to adjust your range a bit. I know that there are lots of different choices of how to do that. So the spreads primarily, but then maybe there's also some other choices as well. So I'd love the rundown on that.
Okay, so yeah, we'll start off with first, like, what's even this concept of adjusting legs, because some people might actually not even be familiar with that. So let's just kind of go into, we're just going to jump out here. This is O&E, by the way. These are options chains if you're not familiar with that. We are just going to throw on something random on here, and then we're just going to start kind of moving it around, right? So something that is probably familiar with a lot of people, they do condors. So we're just going to kind of throw on a condor up here. I'll make it an all put just to kind of keep this thing kind of easy here. Okay, so right now how this is I've got these two trades that are put together here, and they are basically just two verticals that are looking at each other, but a lot of people will just see this as a condor, right? And a condor, all it is two shorts that are closer in on the chain, closer to ATM than your longs. Now, what we're going to kind of dig into here is one step further, which is once we kind of have this trade going, right? And it's active. So here, let's just kind of, we'll commit this guy, commit right here. And we'll just throw him in something like a test account, and it doesn't matter. Okay, so in general, we have like what's called a T+0 line. This is basically what this trade will perform like if the market moves right now, right? So technically you'll gain money on this trade as the market comes down, and you'll lose money as the market goes up. But at expiration, when everything goes down to zero, you will get this expiration graph back here. So that's where your profit is. So just to kind of, we're just going to throw out here some more projection lines. So this is the idea of a step through days, what this kind of turns into, right?
And
so
by expiration day, the slanty line will suck all the way into the sharp lines.
Right, exactly. The curved lines are like those kind of, that's roughly what it's going to look like, right? Or that's roughly what your profit is going to be. You know, it's a kind of a guesstimation. But then no matter what, like the reason why they're flat, solid lines is because that has to be the exact value that you will get on expiration, right? So that's why it's just flat across the top, and then there's this what's called intrinsic value, and that's what's making the diagonal lines. And then of course you've got no value out here at the ends. So what we're going to dig into right now is, are you stuck with this trade when you first put it on? And so the idea of adjusting a trade, and if you're a more advanced options trader, you kind of already know this, but if you're new to this, this might be kind of mind-blowing. I know when I first started out and I was like, wait, what? A trade can be moved after you put it on? Like, yeah.
This is not where I started. Yeah, it's not where I started either. This is not buying a call, hoping for the best.
Right, exactly. And I feel like a lot of options trades are kind of thought of that way, where it's like, yeah, stick it on, it's gonna go, and then just like let it rip, and hope that you kind of make money on it, right? Or it's even thought of as like just like a leveraged tool, where you just basically buy a call and then hopefully it makes money, and then you exit it maybe early, right? You know, depending on if you were right or not. And you don't run it all the way to expiration, that type of idea. But when we start to get into complex options, that's where things start to get a little bit interesting here, because we can move these legs around, I should say. And we can do this with single options too, but let's just kind of look at, if we move this short, right? And kind of imagine we're going to move this short and we're going to move it into a different place. So how do we move it? Well, if we want to move it, we've got to buy back what we already own, right? So we sold 100 here, right? So we buy them back. So let's buy 100, right? Now I know the P&L graph got all weird, but that's because what I was short there, it was long, and we don't necessarily want to go into a position like this. So we're not going to do it. We're not just going to sell all or buy all 100 of our puts back and put us into this crazy risky trade, right? What we would do is we'd like to just slightly shift it. So let's do that. Let's just do a slight shift and move those down here. And let me get rid of some of these projection lines. So all we did here is we bought the options that we sold originally when we first put on this position, and then we moved them down here. Now, what we're going to see here is, just like there's a vertical making this leg of the condor here, there's also a vertical that's making up this adjustment. So what this really is, if I separate these out, is this little vertical is actually this trade behind the scenes, right? Now, what this software is doing is it's saying, hey, if you combine those, what will it look like at the end, right? And that's really what we care about. What's our end position? But always keep in mind that behind the scenes, every adjustment has this structure back here, right? It has this vertical, right? And we can get more complex adjustments and, ratios and diagonals and all sorts of things. But it's basically the same concept, that there's still some sort of structure behind the trade that affected your primary trade. So kind of think about it like that.
And I think when you start hearing about, when you're newer to this and you start hearing about credit spreads and debit spreads, and that all is takes a little bit more pieces of information to put together. But I really like the idea of, you're just buying back what you sold or selling what you bought the first time. And then opening it somewhere different.
Yeah, the names of it can be like kind of daunting at first. Like, oh my God, am I doing a debit spread? Am I doing a credit spread? And it's like, really, all that matters is that, because there's call and put parity and all that, all that matters is just make sure that you buy here and sell here, and it'll do what you think, right? And if you're, because immediately I know here, if I accidentally sold here and bought here, and I combine these guys, right? I combine this, it now is all of a sudden doing something totally different. It's actually giving me more positive delta on here. And when I'm all said and done, I can already look here. I'm going to have 200 shorts, and then I'm going to have 100 longs here, because I'm not canceling what I originally sold out, right? I'm actually adding to it. So that's where you get another break. Something to always kind of also keep in mind in a simpler way to kind of put this is, every angle that you see, every direction change on this expiration line
Mm-hmm.
is another leg of options,
Yes.
right? So that's something to always need. And the sharper the edge, the more contracts you have at that point, right? So you can see here we've got this kind of angle right here, and this has got 100 contracts on it. But you can see that that actually goes completely the opposite direction right here, so there's more contracts at that point, right?
Mm-hmm.
So something to kind of think about, just to kind of put it all into perspective. So to get down to base of what the question was, right, is the idea of having a trade and then moving a leg, how does it impact things, right? And so let's kind of break down just a couple different ways that we can change this trade. Now, before I do that, I'm going to just pull up a blank sheet here and just go, okay, we're going to change all this. For right now, we're just going to use all verticals, right? So let's think about what verticals do what. And I try to kind of think about verticals as like, imagine them like little Pac-Man, right? So the mouth of the Pac-Man is the selling side, and the tail of the Pac-Man is the positive side, right? So he's gobbling things up. So right, we're selling things, we're gobbling them up, and then we're adding things behind us, right? So if we do a negative 100, and then we have a positive 100, you can kind of see what I was talking about with the whole Pac-Man thing, right? The front end, he's gobbling up the things in front of him, right? And he's heading that direction, right? So the shorts are always heading towards where the Pac-Man's face is, right? So this is always going to give us positive delta because our Pac-Man is facing up the market. So you can see over here our strikes are going up, right? And you can see on here on this risk graph that the market is going up, right? The bigger numbers are to the right. So either way that you kind of see it, whether you want to see it on the chain or whether you want to see it on this horizontal type of analytics, you're going upwards. Now, if we flip that around and we put our Pac-Man selling side, right, down the market versus up the market, you can see that now our Pac-Man is going down, right? So what that does is, of course, our losses will happen in opposition of the way that we're facing, right? So if we're facing to the downside and the market goes up, we take losses. If we're facing to the upside and the market goes down, we take losses. And that's because it's against the direction of our Pac-Man, right?
Okay.
The market is hurting us. It's coming into us rather than our Pac-Man working where it wants to. It wants to chase. Our Pac-Man wants to chase the market, not have the market just funnel right into it. It's like drinking it's kind of like if the market goes into our Pac-Man, it's like us trying to drink water from a fire hose. It hurts, right? So that's going to hurt us. So let's go back to our original trade here. What did we that? That was our random. Okay, so now if we kind of have this idea of our Pac-Man inside our head, and we want to profit more from the market going up, right? Let's put a Pac-Man facing up. So here we go. We're going to go and grab this guy, and we're going to negative 100 him, and then we're going to positive 100 him, sorry, and then we're going to go negative 100 up, right? So we have our Pac-Man facing up. So what that's going to do is it's going to make us more profitable to the upside. Now, our original trade back here had negative delta, right? Or negative bias to it. So we would have profited from the market coming down. By us putting on a positive Pac-Man, it offsets that and now gives us more profit to the upside. Now, how many we do and how wide we make our Pac-Man, right, it determines how aggressive our Pac-Man is. And so now, of course, adding a new structure on here, adds more capital. We can go into that another day, but what we're basically talking about here is adding to a trade, we grab that more positive bias. And that works on both sides, by the way. So, like I said, credits, debits, irrelevant, right? Just kind of think about it. Which way is my Pac-Man facing? If my Pac-Man is facing up here and I buy back what I sold up here and I make my Pac-Man face to the upside, my adjustment to the upside, look what it does yet again. I now have more positive bias in the market because my Pac-Man is facing to the upside. So that's in general what an adjustment to a leg does and how it kind of affects things. So that's not the only way to do things, though.
To jump in really
quick. What was that, Michelle?
You can make a Pac-Man to the upside with either a credit spread or a debit spread, right? It just depends on whether you're on the put side or the call side. Is that right?
Yeah, so let's kind of, because this kind of gets confusing for some people. Like, what is a put spread? What is a debit spread? So my terminology is that I'll always call something facing at the money a credit spread, regardless of whether I do it on the put or the call side. That's just kind of how I think about things. That's how I simplify things. Because there's what's called call and put parity. They'll normally match each other where they basically affect. So let's just kind of talk about, or let's kind of zoom into that. If we put 100 contracts here and 100 contracts and negative 100 contracts at 39.30, you can see what it does to our position. We get a lot more negative delta to it. It leans this side. It picks up this side, right? And this is on the put side. Technically speaking, right, this right here is a debit spread on the put side. And what it means by being a debit spread is that technically you're not getting as much credit versus what you're selling it for, right? And that's because your put, it has more intrinsic value than your short. We're not going to go into all that kind of craziness. But just realize that that's why they're calling it a debit, is because it's facing your short is further down on the market than where your long is on the put side. Then on the call side, it's the opposite. So that same structure, right? Like I said, for 39.70 and 39.40. It's the same trade, but it's a call credit spread. It's on the same side of the market. It's facing the same way. The only difference is that now it's on the call side, but both are still have the same impact, right?
So, okay, wait, go over the last part again. So the Pac-Man is still it's facing the same way.
Correct.
But is it also still on the same side of the market?
Yeah. So here's the Pac-Man, and he's above the money, right? So he's above where the market is right now, because that's where the red dot is.
Yeah.
And if I were to take him and put him down here, you can see I've got both trades on right now. Right back here in the background, I'm separating them out so that that's all you see is just the adjustment trade back here.
Yeah.
If I take off one side, it's just going to get smaller, but it's still the same trade.
So
because it's the equivalent of doing double, right?
Ultimately, you're still making the same bet. The only reason it matters is as far as capital efficiency. Is that right?
Well, the capital is going to be the same. What I like to do is I just like to keep things clean. And what I mean by clean is I like to keep things to where I have as little legs as possible. And so I have less execution typically at the end of my trade is kind of the way that I go about it, right? If I'm not going to hold it to expiration. So imagine that we do adjust a trade. And if I were to adjust this trade on 39.70 and 39.30, like we just said, and I combine these two, right? Combine. And now let's say I execute it. So let me just commit this, right? If I commit this trade, then what ends up happening is you can see here that I do have the same trade as what I would have had on the put side. We just explained that. But now at the end of this trade, if I want to get out of this, I have to sell this whole put condor and the vertical because I have a totally different trade on the call side that I've got to deal with now. Because I didn't buy back what I originally owned. I actually, because I owned puts at the time. Now I own calls and puts. Whereas if I were to have done this differently, right? Let me go delete these. If I were to do things differently and bring them down here on the put side, same concept. I'm still, getting a credit spread, quote unquote, credit spread, right? I'm still got my Pac-Man facing the downside, like a call credit spread. But I'm using the put side. If I were to do that, then now after I'm done, you can see it gets rid of my original leg that I had. Because I bought that back and I resold it somewhere else. And now, if I'm trying to close this trade, I just have one order, and that's that condor spread, right? So I don't have to deal with that extra one.
You bought a sweater at Target, and you decide you don't want that sweater. Instead of also buying one at Nordstrom, you just want to take back the one to Target first, and then get one from Target, or you've got all kinds of returns to do.
Perfect. Now, yes, that's exactly right. And of course, we have environmental metrics. So we might be telling you that, like, hey, look, that sweater at Target, yes, was a good deal at the time, but a couple days have passed and now Nordstrom's is running a crazy sale on a better branded sweater. So you might want to go return that Target sweater and go get the Nordstrom sweater. They're going to do relatively the same thing. They're still going to keep you warm, but one's a much better deal.
Totally.